Good day, everyone. In this video, we're going to talk about Fibonacci, and more importantly, how to use it properly. Now, a whole lot of people think they know how to draw the Fibonacci level, but if we're being honest, most people don't. They draw it, but they don't really understand what they're doing. And that's exactly why their entries don't make sense. So in this video, we're going to break it down step by step. We'll start from how to use it properly. Then we'll move into how to get your optimal trade entry levels. We're talking about the 0.68 and also the 0.79. And then finally, we'll go into how to align Fibonacci with other confluences, like fair value gaps, and how to identify the right kind of fair value gaps. So you're not just drawing Fibonacci, but actually using it with intent. So let's start with the first part. Let's talk about how to accurately draw your Fibonacci. Before anything else, we need to get this part right, because if this is wrong, everything else you do with Fibonacci is already flawed. Fibonacci must always be drawn from a clear swing point to another clear swing point. That's non-negotiable. Now, what exactly is a swing point? A swing point is made up of two things, a swing high and a swing low. Let's break that down properly. For a swing low to form, you need 3 candles. The candle in the middle must be lower than the candle on the left and lower than the candle on the right. That middle candle becomes your swing low because price pushed down and then started moving back up. Now for a swing high, it's the opposite. The candle in the middle must be higher than the candle on the left and higher than the candle on the right. That tells you price pushed up and then started moving down. That's what creates a valid swing point. Now, once you've identified your swing points properly, that's when you draw your Fibonacci. Let's start with a bullish Fibonacci level. If the market is bullish, you draw your Fibonacci from the swing low to the swing high. Price moves from a low up to a high. That entire move is your swing. So you place your Fibonacci at the swing low and drag it up to the swing high. Simple. Now here's something very important. The level marked 1 is at the beginning of the move, and the level marked 0 is at the end of the move. So your 1 is at the low, and your 0 is at the high. Now let's flip it for a bearish Fibonacci level. If the market is bearish, you draw your Fibonacci from the swing high down to the swing low. So your 1 is at the high, and your 0 is at the low. If this is wrong, everything else becomes unreliable. Now that you understand how to draw your Fibonacci properly, let's move into how to actually use it. This is where the concept of optimal trade entry, also known as OTE, comes in. Now the OTE levels are the 0.68 and the 0.79. These are the areas where we expect the most accurate entries to come from within a swing. Now understand this. These are not just lines. This is a zone. So we're not expecting price to react at one exact level. We're expecting price to come into that 0.68 to 0.79 area and then give us a reaction. And that reaction is what we're interested in. Now, I want to show you 2 scenarios. In the first one, we took the trade and price stopped us out. In the second one, we took the trade from the 0.68 and it went straight to take profit. Now the question is, why did the first one fail and the second one work? Take a moment, think about it. I'll give you 5 seconds. And I would also love to hear your thoughts in the comments section. Now here's the answer. In the first setup, we only had the OTE, no confluence, so price moved against us. But in the second setup, the OTE aligned with a fair value gap and an inverse fair value gap. Now we had a balanced price range. We had structure. We had context. That's what made the difference. And this is what now brings us to the strategy I'm going to show you in this video. Because in this case, We're not just using OTE levels alone. We're combining OTE with the balanced price range concept. So how does this work? It's actually very simple. First, we identify our swing and we draw our Fibonacci properly. Then we focus on our OTE levels, which are the 0.68 and the 0.79. Now here's the key part. We need those OTE levels to align perfectly with the balanced price range. Once we have that alignment, that's when the setup becomes valid. Now for execution, we take our entry at the 0.68 level. Our stop loss goes at the swing low, and then we target the swing high. This is for bullish examples. For a bearish one, stop loss will be at the swing high and take profit will be at the swing low. It's a very simple strategy, very mechanical, and very easy to follow. No guesswork, no overcomplication, just clear rules. Now let's go to the charts. We'll start from the 1-minute time frame and work our way up, because this works across all time frames. So starting with the 1-minute time frame, here you can see a swing high and a swing low. Since price is bearish, we draw from the swing high to the swing low. Now we look at the OTE zone, the 0.68 and the 0.79. You'll notice it aligns with the balanced price range. So we take our entry at the 0.68. Stop loss above the swing high, target the swing low. Price comes into the zone, respects it, and drops into take profit. Now let's look at a bullish example on the 5-minute time frame. We have a swing low and a swing high. So we draw from the swing low to the swing high. Again, the 0.68 and 0.79 align with the balanced price range. Entry in that zone, stop loss below the swing low, target the swing high. Price taps the zone and moves to take profit. Now the 15-minute time frame, same process. Swing high, swing low, draw from high to low. OTE aligns with the balanced price range. Entry at 0.68, stop loss above the high, target the low, and again, price delivers. So for the final example, we're going to use the 1-hour time frame. And this one is a bullish setup. Here you can see that we have our swing low, and then we have our swing high. So because we are looking for a bullish move, we draw our Fibonacci from the swing low up to the swing high. Now once that is done, we shift our focus to the OTE zone, which is the 0.68 and the 0.79 levels. And when you look closely at that area, you'll notice that price left behind an overlapping bearish fair value gap and a bullish fair value gap, which gives us our balanced price range. So now we have alignment. We have Fibonacci, OTE, and a balanced price range, all in the same area. So what do? We take our entry directly from the 0.68 level. Our stop loss goes at the swing low, and then we target the swing high. And as you can see here, price comes precisely into the zone. It taps into the balanced price range, respects the OTE level, and then pushes straight up into take profit. Now I could show this on the 4-hour, the daily, the weekly, even the monthly, but I don't want to make this video too long. What I want you to do instead is this. Go to your charts, mark your swings, draw your Fibonacci, and look for this same alignment, because that's how you truly understand it, not just by watching, but by applying. And that right there is how you use Fibonacci properly with real confluence.